The wealth management industry has a dirty secret that nobody talks about. Your advisor makes more money when you have more money. And on the surface, that sounds completely normal, almost intuitive. But consider this. They make more money even if they had absolutely nothing to do with you getting it. If the market goes up 20%, their fee just went up. You get a bonus at work and add it to your portfolio, your advisor charges you more. You inherited money and moved it under their management, your advisor just got a raise. You sold your business and brought the proceeds to your advisor, you guessed it, your fees just went up. And this structure doesn't make much sense to me. My partner Sam and I started Valorem Wealth because we couldn't stomach this anymore. Between the two of us, we worked at firms big and small, wirehouses, boutique RIAs, everything in between. And we kept seeing the same patterns repeat themselves. The first pattern was firms charging something like a 1% management fee to put clients into a 60-40 portfolio or some other passive allocation and calling it wealth management. Think about what that actually means. If you have $500,000, you're paying $5,000 a year for someone to maintain a portfolio you could build yourself in 20 minutes on a Saturday afternoon. If you have $5 million, that same portfolio that's managed the same exact way costs you $50,000 a year. The work is identical, but the price is 10 times higher. The second pattern was even more frustrating. Firms charge that same 1% fee, but instead of a passive portfolio, they'd try to justify it by actively managing your money. Things like stock picking, market timing, trying to beat the market, and year after year, the data is pretty clear that most of them don't. According to S&P's SPIVA research, over 90% of active managers underperform their benchmark over a 20-year period. So clients were paying premium prices to do worse than an index fund that they could buy for almost nothing. The third pattern was the one that bothered me most because it's the least visible. You've probably heard advisors say, when you make more, I make more, and we're aligned. That line gets used constantly in the industry, and it sounds reasonable until you actually think about what alignment means. Real alignment would mean they only do well when you do well because of their work. What actually happens is they make more money anytime your balance goes up, regardless of why. As I mentioned earlier, if the market rallies, your advisor benefits. You add money from a bonus you got at work, they benefit. You bring over money from an inheritance, they benefit. They didn't earn any of that. They're aligned with your account balance, not your success. And those are two completely different things. It gets worse. A well-documented pattern in this industry is advisors steering clients towards products carrying considerable upfront fees and performance carry. Not because those products are the best fit for the client, but because they pay the advisor well. The SEC has cited conflicts of interest around product distribution as one of its primary enforcement concerns for years. This is not a fringe issue. It's baked into how many of these legacy firms operate. Many investors know that fees matter, but few understand exactly how layered costs and incentive-based fees quietly reduce long-term returns. They just have this feeling that something is off, even if they can't quite put their finger on it. That feeling is often correct. Two moments personally crystallized this for me. The first was sitting across from a client who had been with their previous advisor for about a decade. They came to me for a second opinion because they had this lingering suspicion that their portfolio wasn't performing the way it should. They weren't really investment savvy enough to really diagnose it. They just couldn't shake off the feeling that something was off. So naturally, I asked to see their statements. As we went through them together, two things became clear. The first was over that 10-year stretch, they had paid their advisor roughly $500,000 in management fees. Second, the investment performance was absolutely abysmal. Their advisor kept telling them tech was in a bubble, so they avoided the sector for years. During that same stretch of time, companies like Apple, Microsoft, Amazon, Nvidia, and Google were compounding at extraordinary rates and driving a huge portion of the overall market. Over time, that gap became enormous. For every dollar the S&P 500 made, those clients captured about 40 cents. Now think about what that actually means. They paid $500,000 in fees to dramatically underperform the market. We're talking about the difference between putting grandkids through college or not, buying a second home or not, retiring 10 years earlier or working into your 70s. They paid extra for advice that set their financial future back significantly. The second moment wasn't one specific client. It was being in the room when private deals were being discussed and watching how they got distributed to clients. Here's what happens. A private deal or investment already charges its own fees, which is normal. But then, the wealth management firm recommending it often gets paid as well. Sometimes it's as much as a 1 to 3% upfront fee just for placing the client into the deal. Sometimes there are ongoing revenue shares on top of that. So before the client makes $1, multiple parties have already been paid. And here's the part most people don't think about. Once you sign on the dotted line, that upfront check is already earned. The wealth management firm and the advisor gets paid immediately. After that, there usually isn't any incentive tied to regularly updating you, walking you through performance, or proactively checking in. The financial incentive was tied to getting you to say yes to the deal. So what naturally gets prioritized? Getting people to sign on the dotted line, of course. I'm not saying any advisor wakes up trying to do something wrong or malicious, but incentives drive behavior. And when the money is made, the moment of the sale, the focus tends to be on selling, not long-term stewardship. Clients deserve to understand that. That's when it clicked for my partner Sam and me. What if there was a firm that charged the same modest flat fee regardless of what it recommended? Zero incentive to steer clients toward higher fee products because there were no product fees to collect. That would be genuinely valuable, and nobody was doing it. So we built Valorem, and here's exactly what Valorem is. You pay one flat annual fee of $15,000 for comprehensive wealth management services. That covers financial planning, investment management, access to institutional-grade private investments, and ongoing advice. You get a dedicated advisor who knows your situation and is available when you need them. You pay the same amount to Valorem whether you have $2 million or $20 million. The work we do doesn't change based on your account balance, so the fee doesn't either. Here's why that matters in practice. Take a hypothetical client who has a $3 million portfolio growing at a standard market rate of 8% per year for 30 years. With a traditional 1% advisory fee, you'd pay roughly $2.8 million in fees over that time period. With a flat $15,000 fee, you pay approximately $450,000. That's over $1 million difference in fees on its own. And the money you're not paying fees keeps compounding for you rather than going into your advisor's pocket. Over 30 years, the difference between paying 1% and paying a flat $15,000 fee comes out to just over $5.5 million in ending portfolio value. The same portfolio, the same returns, but a dramatically different outcome based entirely on how your advisor gets paid. Beyond low fees, we give clients access to private investments that most advisors never show you. Things like private equity, private credit, specialized real estate opportunities, energy deals, the same types of institutional-grade opportunities that family offices and endowments have been using for decades. And as a registered investment advisor, we operate as fiduciaries. Every recommendation is made because we believe it's right for your situation, not because it lines our pockets. We're not going to tell you the entire industry is evil. There are good advisors out there doing right by their clients. It's simple that the incentive structure is deeply problematic. When your advisor gets paid more because your portfolio went up, they're just along for the ride. Valorem exists because wealth management should be transparent, efficient, and structured so that our interests are genuinely aligned with yours. You should know exactly what you're paying. You should pay for the work that's being done, not for how much money you have. And you should have access to the same quality of investments that institutions use. Many people have a feeling that something is off with how financial advice is delivered. That feeling is often right, and there is a better way. If this resonates, or you've had that quiet feeling that something isn't adding up, I'm happy to take a look at it with you. No pressure, we'll walk through what you're paying, how your portfolio is performed, and whether it aligns with your goals. The link to book a call with me is in the description below. I hope to speak with you soon.